Hello and welcome to Market Domination. I'm Josh Lipton, live from our NYC headquarters. Stocks have turned mostly lower today here as investors navigate a flurry of developments across multiple fronts. Here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
So what we've been monitoring here at Raymond James is kind of exactly when and how big a strike could be. I think most of the investors that I've talked to are really focused on this nuclear facility that's underground at Fordo. If there is to be U.S. involvement, the most likely outcome there would be the potential use of a bunker buster bomb, taking that out. I don't think that the market is pricing in a longer term conflict.
I don't want to downplay the seriousness of what's going on because it is certainly serious. But when one looks at United and American, for example, Middle East is a relatively small piece of the pie. You now have some additional complexity to this flying. So I think at this early juncture, it's small enough and they have enough flexibility that they can mostly mitigate the issue.
This launch really, in my opinion, is the bold announcement on the next phase of the software-defined vehicle. And what I would say there is Tesla's approach is really around data. Their strategy is about collecting more data, which we know for AI really drives the AI engine. And that gives them a real advantage, and one that I think will ultimately win out over the competition.
We've got 1 hour to go until the market close. Jared Blickery, Josh Schaefer, and Inez Ferre all here with me to break down some of the moves. Jared, we're going to start with you, my friend, with an update on the markets.
Thank you, Josh. We are seeing a little bit of negative action here. The good news is it's not a lot. We're talking about 18 whopping points in the Dow, down about 5 basis points total. And here's the picture. Here's where we started out the day, gapped up just a little bit in the green for most of the day, but now we have sunk into the red. And let me just show you the 4-day total here, because this is a shortened holiday week. And let's admit it, this is the summertime, and so we're not seeing a lot of action in the majors. But the Dow down just barely over these 4 days in the red. Here's the S&P 500, that's down 0.25%, and the NASDAQ, that is actually up this week by 11 basis points. And I'd be remiss if I didn't touch on volatility here. The VIX has been oscillating around the 2011 for quite some number of days here, so not a lot of action there. I should mention too, it is options expiration date. If we have some time, I can get into that, but I just want to show you what's going on in the bond market. A little bit of downside action there as well, 4.38% in the 10-year, and then the U.S. dollar index, that's also down. So if you're keeping track here, we got stocks and we got rates and the dollar all down, and I'll just leave you with the sector action, kind of a mixed board here.
So, Jared, you did mention it is options expirations day. So walk us through, Jared, what do we need to know about that? What do we need to be watching into the close?
Well, it's interesting. About $7 trillion in notional is rolling off today. We don't know the exact number, but that could be a record. However, it's kind of a misconception that we have higher volatility on these days. We have higher volume, but not necessarily volatility. And that's because stocks like Apple, and let's just take a 4-day look at Apple, that will get pinned to some of its big strike numbers, like the big fat 200 level. So it'll stick there, and this just kind of compresses volatility. But we do have about $2 trillion in options on individual stocks that are heading into the close here, so we do have some action potentially over the next hour.
All right, let's get Inez into this conversation as well here, because oil prices, we know, have been in focus this week. Where do they sit at currently, Inez?
Yeah, Josh, and oil posting its third weekly gain. So even though we saw volatility when it came to oil prices throughout the session today, oil is up for the week, both for WTI and for Brent crude. WTI futures down just 0.2%. Brent crude up about 0.5%. It was a volatile session today, mainly because Trump waiting for 2 weeks to make a decision on Iran. That sent oil prices lower earlier in the session. Also, you had talks in Geneva between top European diplomats and Iranian diplomats, so over their nuclear program. So that is fueling some optimism that diplomacy is at work. Wall Street has said if we see a spike in oil when it comes to this Israel-Iran conflict, it's most likely temporarily. And we certainly have seen that spike since the conflict initiated last Friday. But Citi is saying that affecting Iran's oil supply is not to the benefit of the U.S. And if Iran's exports were to be interrupted, then you could see oil WTI or Brent anywhere between $75 and $78 a barrel. Well, look where it's trading right now at 77. Goldman Sachs is saying that if Iran's supply were to be disrupted, you could see oil spiking to $90 a barrel. But Goldman Sachs is saying that it's going to come back down into the 60s by 2026 because of OPEC Plus's spare capacity. Remember that OPEC Plus has been increasing output over the last several months leading up to this conflict.
All right. So that is an important check on the oil markets. I also want to bring in Josh Schaefer now. And Josh, really a headline today, and here's where I want to start with you, was Fed Governor Waller, who gave an interview to the press. He was talking to the financial press. And Waller says, you know what? The central bank, he says, maybe they could cut rates as soon as July. And that got a lot of attention, a lot of headlines, got people talking. What did you make of it when you saw that?
Yeah, Josh, I mean, you saw sort of in that summary of economic projections in the so-called dot plot that there's clearly a divergence right now within officials, right? There are some officials that see 2 cuts, the majority of officials seeing 2 cuts, but then there's still 7 officials that see no cuts, right? And so the question is always, well, who are the dots, right? And clearly, based on how Waller has been speaking for months now, he's been an official that's arguing for cuts. So I don't think that necessarily is that surprising. What was interesting was the concept of him bringing up July, right? July has not felt like the meeting that folks are sort of arguing over right now. It seems like the market has been talking a lot more about September. But I thought it was interesting. Waller said, you know, the data so far has been fine. Well, you have core PCE expected to come out next week, supposed to show a little bit of an increase. That's the Fed's preferred inflation gauge, a little bit of an uptick from 2.5 to 2.6. Then what happens when you get over to the next month of data too? This is all data that the tariffs are actually in. It just seems like, okay, the point is made. And the market moved a little bit on it this morning. Stocks actually popped slightly on this news, but I don't think that the market is going to overlook necessarily what one official is saying when we're going to be hearing from almost quite a few officials over the next week. I think there's 20 different instances where a Fed official is going to be in front of a microphone over there.
The other big theme we talked about, Iran, Israel, running red hot. I know you've been looking through the market research. What have the strategists been saying about that? How should market participants be thinking about that conflict?
Yeah, so a lot of the strategists right now are focusing on oil, right? So Citi strategist Scott Kroner was out today saying that he thinks the price in oil is sort of the key here, right? We were talking to Ed Mills earlier that played in the soundbite for us. He said that the key right now is essentially that markets haven't priced a long conflict either, right? I mean, Jared just highlighted over 4 days, the S&P 500 is basically flat. Dow's basically flat, NASDAQ's glorified flat, right? So really you're at a point where the market has not priced in a large conflict. So the question would be, how high do oil prices go? What would that do to inflation? What does that do to the Fed story we just talked about? And how does that change the narrative? But at this point, oil at $75 a barrel is not moving the needle, right? You would probably need to see oil over $100. You and I had talked earlier this week, maybe oil WTI at 120. I mean, that's $50 more than we are right now. So serious escalation is what strategists are watching for to sort of then be considering different outcomes.
And Nez, I want to bring you in here back as well, because a key consideration has been for the oil markets has been the Strait of Hormuz and whether Iran would make a move there. If they did make a move, Nez, to obstruct, what would be the reaction and response?
Well, certainly you would see a spike in oil prices, and Wall Street has been clear about that. But Wall Street doesn't see Iran doing that. Look, the Strait of Hormuz carries about, per day, about 20% of the oil flow through there. So it's very important. It's critical. But Wall Street is saying that it would not be to the benefit of Iran to do that. It wouldn't be to the benefit of Iran's big customer, China, to do that. And also, Goldman Sachs pointing out this week that you haven't seen Iran supply interrupted. And and you haven't seen any interruption through the Strait of Hormuz, so those flows flowing through that critical choke point. JP Morgan also put out an interesting point this week, saying that if Iran were to close that strait, that would be considered an act of war by the U.S. because the U.S. has a fleet in the area that is protecting the commercial flow and has for decades now. So the consensus is that there's a very low probability of that happening. But of course, if it were to happen, then certainly the knee-jerk reaction would be you would see oil prices go higher.
Inez, Jared, thank you guys both so much. Schaefer, you are going to stick around here with me. Stocks falling with an hour to go till the final closing bell of the week. For more on the latest market moves and what comes next for investors, let's welcome in now Thomas Serrano, Sage Advisory Managing Partner. Thomas, it is good to see you. So a lot on investors' plates, Thomas. Fed, Israel, Iran, red hot, tariffs. How are you trying to think through this, Thomas? As an investor, how are you trying to navigate these cross currents?
Yeah, there's a number of cross currents, as you said, that the bond market is trying to digest currently, right? And I mean, we've gotten through some tariffs and then the change in tariffs and kind of constantly evolving policy and tariffs, and it's putting a lot of confusion into it. We moved past the House version of the tax bill. The Senate version of the tax bill is coming up. I think the focus will move towards that, while the Iran-Israel situation kind of percolates. Well, I guess Trump said we have 2 weeks to wait and see how diplomacy works there. And then the Fed, of course, coming on hold for now. But the Fed's upcoming policy is still up for debate. It seems like the Fed's on hold. So, in some instances, you might see a typical flight to quality trade out of the conflict in the Middle East. That's not really happening in any large degree. The Fed on hold kind of left the market in limbo, meaning they're not committed to cutting, but they're not looking to raise rates. So it's more of a sideways move in yields. And I think, honestly, as we get through some of this over the next 2 weeks, the Senate bill and how they negotiate that is going to come into focus and how that impacts the deficit moving forward.
Thomas, you brought up an interesting point that we haven't really seen a large version of a flight to safety trade over the last couple of weeks, right, as this Middle East conflict has sort of boiled. I mean, what position do you think that puts the market in if the conflict does get worse? Is there a significant flight to safety trade potentially waiting on the other side then?
Yeah, I think there's a potential for that. Typically in some sort of geopolitical conflict scenario, there is a flight to quality trade, right? And you might see a 25 basis point rally in rates. Well, we didn't see that. We saw a very small move lower and then the kind of reverse course. So effectively, I think that puts the baseline assumption for the market on this Middle Eastern conflict as it's going to be regionally contained and that this diplomacy ultimately works. But I do believe, if diplomacy does not work, if the U.S. gets involved, starts, with the bunker buster bombs, and that signals a direct involvement in the U.S., and does that suddenly draw in some other countries into this mix and becomes a much broader issue, I think you see that opens up the door for that flight to quality move. Because it opens up a lot of uncertainty in terms of what countries are going to participate, how big does this conflict become, is there a potential off-ramp for that conflict? And while you wait and see how that impacts risk markets, a typical move in treasuries would be, would see some investors pile into that space.
Thomas, you mentioned how the Fed does seem to be on hold. We all heard Jay Powell this week, and certainly it does not look like a Fed that's in any rush to cut. I mean, you listen to Powell, and he clearly wants to see how tariff inflation plays out. Does the market need a cut, Thomas, to move higher?
I don't think the market needs a cut. The bond market may need a cut to move higher from here. But I'm not exactly sure the equity market needs a cut. The economy is doing okay. I think, the takeaways from the meeting was the Fed expects the economy to rebound strongly in Q2, but then kind of come with a kind of a slightly below average growth rate, mid ones, 1.4, 1.5 range for 2025. So that's not a really strong growth picture. So I'm not sure that really supports rising multiples and rising earnings expectations in the equity market. But on the other hand, a slow growth, I think it does set the bond market up for considering at some point in 2026, the Fed does get the ball moving on pushing policy rates lower. But that, I think, is all predicated on this idea that inflation or tariff-driven inflation remains kind of moderate or low. And the idea that transitory inflation, that's changed to anticipatory inflation, meaning I think Powell suggested the Fed expects tariffs to cause what he described as meaningful increase in inflation, although we haven't seen that yet, right? We've realized inflation over the first half of 2025 has been quite low. So we haven't seen any pressure on that front yet. I think all of that is what leaves the Fed just kind of in this wait and see mode.
I mean, Thomas, does that leave, taking all that together and then just looking at something simple like the 10-year, right, at 4.37 right now, is it just too high? Are you expecting that to come down at some point based on all those things you were just laying out there?
I think the 10-year note at somewhere between 4.5 you can hang around that zone for a longer period of time. I think what's more interesting is the 2-year note hanging around 4%, right? And ultimately, if the Fed is going to engage in a policy shift lower, meaning target range, I think out of the dot plot somewhere around 3.5, maybe 3.25, that sets the stage for a bit of a rally in the front end of the curve, which would then ultimately kind of provide some slope, positive slope back to the yield curve. 2s, 10s get a bit more slope in there, which I think is a healthier picture.
Thomas, finally, I want to ask you about the AI theme, that mega trade and trend. I think, heading into the last earnings season, I think there was some questions about the AI boom and would big tech keep spending as much on it. I think they clearly seem to support the idea they intend to keep spending all kinds of money building out their AI infrastructure. How bullish are you on that theme, Thomas? How important is it to keep this market grinding higher?
So I think the AI theme is important. It's certainly been a source of supply in the bond market, meaning we have seen a number of data center issuers come to market to raise capital for data center construction, infrastructure construction. I think XAI was out in the marketplace today, issuing bonds to help fund grok development. So, to the extent that corporate America is committed to that space, it's very clear in the debt markets because we see the financings for these projects onboarding. What that tells me is that the amount of capital is still being raised currently for deployment still leaves a lot of upside in terms of CapEx spending in order to facilitate growth in the AI space.
All right, Thomas, Josh, thank you both guys for joining the show today. Appreciate it.
Great, thank you.
We're just getting started here on Market Domination. Coming up, the United States reportedly weighing canceling waivers that allow some global chip makers to send American technology to China. We'll speak to an analyst about all that on the other side and what it means for the industry. Stick around, much more Market Domination. That's still to come. The United States is reportedly weighing canceling waivers that allow some global chip makers to send American tech to China. That's according to the Wall Street Journal. The move could strain relations with South Korea and Taiwan, whose companies would be most affected by that change. For more, let's welcome in Matt Bryson, Wedbush Securities Managing Director, Equity Research. Matt, always great to see you on the show. So let's start with this report, Matt. I mean, certainly the Journal made a lot of headlines with it. They're saying, listen, the U.S. might indeed revoke or cancel these waivers that allow global chip makers to send American tech to China. You know this sector, Matt, well. You cover the industry for a long time. You saw that headline and that report. What did you make of it?
Well, I immediately thought about the Korean memory makers, right? In the sense that both Samsung and Hynix produce a lot of product in China. It's a bit unclear to me exactly what proportion of that product might be affected. Is it all of it? Is it some portion of it? But I mean, that's what struck me right away.
When we talk about this American tech that's going to China, what kind of American tech are we talking about exactly, Matt?
Yeah, so I'm thinking it's the semiconductor capital equipment. So you're talking about applied materials, you're talking about Lam, and I'm assuming it's used in some sort of process tech. So I'm not sure if there's a point in the sense that it's only the more advanced technology that's being restricted, or if there's no cutoff point. But at least that would be my assumption. But again, there's not a ton of clarity around exactly what might be restricted.
Would you guess, Matt, if we talk about the kind of chips that might be impacted here, would you think it would be, the latest and greatest chips? Would it be more memory, more logic, the kind of chips that would go into your car, your consumer electronics? What do you think?
Yeah, so if you're looking at those Taiwanese companies, so you're talking UMC, you're talking Taiwan Semi, the amount of manufacturing they have in China is minimal, right? You're talking for both those vendors, low single digits. Those are They're more mature technologies, so those would be the types of chips that would go into your car. But again, they have product elsewhere. I tend to think about them using those Chinese fabs to make product for China. So it just wouldn't really have much impact on us, wouldn't have much impact on their top or bottom line. On the memory side, though, you're talking much larger kind of portions of Hynix and Samsung output, and then certain products are somewhat unique. So Intel's old memory fab, which is in Dalian, China, it makes a high capacity NAND chip that really isn't comparable to what anyone else makes. Hynix has been able to dominate the market for high capacity SSDs. And so if that's affected, it has some real ramifications for the market, since most of that product ends up in the US.
You know, I want to just drill down real quick into one name you mentioned, which is Taiwan Semi, because I know you cover the name, you like the name, you tell clients it's a buy. What you're arguing, Matt, seems to be, listen, even if this waiver did get revoked, it got canceled, the financial impact here for TSMC would be, you're suggesting, not material.
Yeah, I did the math around wafer output, and I came up with less than 2%. It's older process, so pricing on that is going to be well below what they're getting for the chips they're making for NVIDIA, say, Josh. And so you're really looking at, I would say, less than a percentage point of revenue.
Kind of a broader question just to end here, Matt, because I know you cover the sector for a long time. It's interesting how American administrations, listen, they don't want China having access to the latest and greatest American tech. They don't want an adversary having access to that tech. And so they've tried different policy tools. It's export controls. Maybe we cancel a waiver like this. Do we have line of sight, Matt, in terms of the kind of impact these policy moves, these policy tools are having on the domestic Chinese chip space?
I mean, certainly they've been able to restrict China's ability to make advanced semiconductors, right? So my sense is SMIC, which is the most advanced of Chinese fabs, they're getting 7 nanometer out, which is 3 process generations behind TSM, but it's at relatively low yields. I mean, they're trying to improve on that. But I think not being able to get the ASML equipment, there's certainly impact there. And so when you're thinking about advanced AI products, for instance, it just limits to some extent how much performance China can get out of its chips. And so they can't really compete on the technology side.
Final question, Matt, just because I have you, I want to ask. I know you cover Micron as well. I know you like that name. They're reporting next week, June 25th. What do you expect to hear?
Their enterprise market's gotten better. And so I expect them to tell us that their mix was better in the quarter they're reporting. I think that's going to benefit both pricing and margins. And then moving forward, things aren't quite as good as they looked before we had the U.S. reciprocal tariffs announced. But having said that, over the last month and a half, projects for AI, projects for enterprise have picked up a bunch. And I expect that that's going to lead to pricing still being up in Q3 through the back half. And so you're going to get a relatively optimistic tone from management.
Matt, great to see you as always. Enjoy the weekend.
You too. Thanks, Josh.
The market's digesting the Fed's decision to hold interest rates steady in June. As Wall Street looks ahead, some Fed officials are signaling that July could be the month we start to see cuts. For more, we're bringing in Jeffrey Lacker, Senior Affiliate Scholar with the Mercatus Center and former Richmond Fed President. Jeff, it is good to see you as always. I wanted to start, Jeff, with Fed Governor Waller talking to reporters today, talking to the financial press, and certainly making some headlines. He was saying, you know what? You know, maybe the central bank could start cutting rates as soon as July. I'm sure you saw that headline too, Jeff. What did you make of it?
July strikes me as quite premature. I take him at his word that it's his good faith analysis, but that seems awfully optimistic for a couple of reasons. First, inflation isn't quite down sustainably at their 2% target yet. I've had 2 months of some good numbers, but 2 months ahead fakes is like not at all uncommon. And there's some peculiarities in those 2 months that make it seem plausible that that's not sustainable. I'd point out that wage growth isn't really in the ballpark, isn't quite there yet in terms of their 2% target. I'd point out that the timing is really peculiar. So, we've had some tariffs in effect for a little bit now. As Chairman Powell pointed out, a lot of firms are just selling the inventory they have, the pre-tariff inventory, at pre-tariff prices. And so we don't really have a bead on the effect on inflation of the tariffs that are in place now. And then you have the Liberation Day tariffs, which are quite dramatic, quite significant. They were paused in early April until sometime in July. And so, and we don't know how those negotiations are going. So we don't know how many of those are going to come on board. When they do come on board, if they come on board in July and we don't get another extension, well, then it would take like 3 months of data really to have any sense of how that's affecting the inflation picture. And September data isn't going to come in until October. So October is the earliest plausible date that I think they could have a sense of how the tariff numbers, how the tariff policy is really playing out and affecting the inflation outlook.
Jeff, when we see that tariff inflation, though, I'm curious whether you think it's going to be a kind of one-time bump, which seems to be what Waller thinks, which I think plays into why he thinks, hey, we could see a cut sooner rather than later. Or no, do you think it's going to prove more persistent?
So I'd point out that the fiscal stimulus of 2021 that led to the dramatic surge in inflation, in principle, that also should have been a one-time level effect on the price level. But we've seen with that if the Fed lets it run, doesn't tighten policy in the face of that, then it can turn into a more persistent surge in inflation. And I think the Fed's got to be worried about that, both on its own grounds, but also just because the recent experience in 2021 is going to leave consumers and businesses with less confidence that the Fed's going to get on top of things with alacrity. I'd also point out that a demand surge is going to wash over the whole economy and raise a whole broad array of prices. That's what inflation is. Tariffs, on the other hand, are just hitting some products, not others. Presumably domestic goods and services aren't going to see tariff effects. Well, then what you're talking about is a relative price change. And for the Fed to keep inflation under control, it's got to, in some sense, induce offsetting pricing weakness in non-tariff affected goods and services. So I think on both grounds, I take cold comfort from the argument that these tariffs are just going to be a one-time level effect.
Who do you think, Jeff, pays for that tariff? Who's going to ultimately eat that? I mean, it was interesting because Jay Powell, you listen to him this week, they're still thinking and sussing through that. I mean, do you think is it Jeff and Josh? Is it sellers? Is it producers? What do you think?
Ultimately, it's going to be Jeff and Josh and a host of other people in the U.S. economy. Now, some early reports suggest that some intermediaries that are importing goods from China are getting some of the suppliers to eat some of it. They're eating some of it themselves. They're not passing it all on. I'd expect that to happen for a couple of months as people feel their way, find out what their competitors are doing. But, if they had a certain rate of return they were paying themselves as a importing intermediary before tariffs, that's probably going to be the equilibrium level of return that they extract out of the business after tariffs have washed through and the effects have rippled through the economy. So I'd expect that to be a temporary effect, that a temporary sort of gift to their customers, something to maintain relationships for the time being, and down the road, ultimately, it's all going to pass through to consumers.
And finally, Jeff, I just want your thoughts, how you would characterize the labor market now and ahead. I mean, you saw June Philly Fed today, the employment component went negative. So I'm curious how you see the labor market evolving.
So there does seem to be some hesitance to commit on the hiring front. Some diminished willingness to post openings and hire. I think that's understandable given the magnitude of uncertainty in the first half of this year about the economic environment we're running into. There haven't been large layoffs though, and there doesn't seem to be a labor market shock and trend that would precipitate a sharp unraveling in labor market conditions. So labor market conditions are softening a bit, but that doesn't seem sort of demand related. It doesn't seem to be related to ultimate spending. Seems more related to just firms taking a pause and holding back on commitments at this point.
Jeff, it's always great to see you and to have you on the show. Enjoy the weekend.
Great. Yeah, thank you. You too, Josh.
Coming up, we speak to an analyst who says a successful robotaxi launch is essential for Tesla. But when will the launch happen? Stick around. Much more market domination. That's still to come. Tesla set to roll out their robotaxis this weekend, and our next guest today says a successful launch is essential for Tesla to validate the company's long-term pivot toward autonomous mobility. For more, let's welcome in now Stephen Jengero, Stifel Next-Gen Transport Analyst. Stephen, it is good to see you. So Tesla's robotaxi service rolling out this weekend there in Texas, Stephen. What do you expect to see and hear, and how excited should investors be for this moment?
Yeah, hi, Josh, and thanks for having me again. So when we think about Tesla in general, right, the robotaxi initiative and the full self-driving initiative are critical long-term value drivers of the company. And we've talked a lot about that in research notes. When we think about this weekend, I mean, we think this is going to be a slow process, right? This morning, you already had some senators and some folks, I think, that were local representatives down in Texas wanting to sort of delay the launch till more safety can be checked. But this is going to be a slow process. You're probably going to see, expected to see 10 or 20 vehicles on the road, Model Ys, that are being very closely monitored by Tesla. So this is, a very slow process, but it is obviously, the first step in something which can be much, much larger over time.
And in terms of how it expands from here, Stephen, here was Dan Ives, or Wedbush, we know Dan, bull of bulls on Tesla, told his clients that he said, while the Austin launch will start off small with roughly 20 Model Y vehicles, he says, it's our view Tesla will launch and scale its robotaxi service to roughly 25 cities in the U.S. over the next year. What do you make of that?
Well, I think the first thing that we have to think about, Josh, is safety, right? And I think one of the risks to the launch is obviously the safety of the autonomous driving system. And if I get in an accident on the way to work on Monday, nobody's going to know or care. If a robotaxi bumps into a fire hydrant, it's going to be in every news feed probably in the world, right? So there has to be a really careful focus on safety. So when we think about the next steps from here, I do think you're going to see it roll out over the next 2 to 3 quarters in multiple cities in the U.S. I think it's going to be measured. I think it's going to be a slow process. I mean, when we think about the importance of it to Tesla, I don't care that much if it's in 3 cities or 5 cities or 7 cities by December 31st. What I care is that if there's a clean launch, it goes smoothly, and the safety record is extremely high. And I think Tesla understands that. So while we do build in these significant long-term upside potentials for the company, and the robotaxi initiative is obviously a big part of our valuation, I think the near term, the focus on safety is more important than how many vehicles are actually out there.
Waymo, we know right now, Stephen, far ahead. What are Tesla's competitive advantages in this space? When you explain them to clients, what do you tell them?
Yeah, it's interesting. I've been in Waymos and full self-driving Teslas, and the first thing that jumped out to me was that the Tesla system felt more natural, right, in the process. Now, when you look at the Waymo system, and this is on the vehicles you see in San Francisco and other cities, or sounds like they're coming to New York at some point in the not too distant future, they have multiple redundancies in the system. Right? They have cameras, they have LiDAR, they have radar. And they because of those redundancies, I think people look at them and say there's a higher level of safety. When you look at the Tesla system, it's camera-based and it's AI-based, and they have massive quantities of data to do the analysis. To me, the vehicles kind of felt a little more natural. But what we tell people is, the lack of redundancies, the camera-based system only, there are some risks to that. Now, on the positive side, there's really three big benefits, right? One is cost, right? If you're talking about a robotaxi, which is shown on the screen right now, or whether you're talking about a Model Y that I subscribe to FSD with, the car could be $30,000 or $40,000. A Waymo fully equipped with all the sensors, et cetera, is well north of $100,000. So cost is one. Second is, I think, clearly the massive fleet of Teslas that are out there right now, which can become part of a robotaxi fleet over time. So if I have a Tesla Model Y in the driveway and I have full self-driving, theoretically I could drive that car to work and dump it into the robotaxi fleet. So the ability to scale based on the massive installed base is probably the second big positive. And then the third is their ability, I think, to have some flexibility, whether it's some Tesla-owned assets owned by individuals, and even partnering with at some point, or even using me having a Tesla and dumping it into an Uber or a Lyft fleet if I so choose. So there's multiple avenues for the company over time.
And finally, Stephen, next events for Tesla investors they have marked on their calendar. You got Q2 deliveries, Q2 results. I know you're a fan of this name. You got to buy. What are you expecting to hear, Stephen?
Yeah, I think one of the things that's honestly hard, Josh, is we get a lot of data points on sales, right? We hear Europe's a problem. We hear there's some pockets of Europe which are pretty strong. The Model Y rollout, the new generation of the Model Y, which was rolling out through the first quarter, clearly was a headwind on 1Q numbers. We do expect to see a pretty solid sequential increase in the second quarter. The macro environment remains a little bit uncertain, but we do expect to see momentum in sales, and obviously we do expect to see some traction on the FSD side. I think those two data points, ultimately should be positive catalysts for the stock as the year evolves.
Stephen, always great to see you and to have you on the show. Thank you, sir.
Thank you. Have a nice weekend.
You too. Coming up, taking a look at some of today's top trending tickers. Stick around. Much more market domination. That's still ahead. Now time for some of today's trending tickers. Yahoo Finance's Josh Schaefer back with me now. We're going to be watching shares of Oscar Health, Kroger, and Couchbase all rising in today's trade. We're going to start with Oscar Health. It's up 50% over the last week and seeing its third day of consecutive gains, driven by the bullishness of the insurance industry. Telehealth company reporting a 45% price increase since last quarter because of the company's excellent first quarter earnings, and its growth is astounding given the health insurance industry has been relatively flat recently. Additionally, a new proposal to create Part E of Medicare, a voluntary self-funding plan, assisting in the rally for this stock, Josh.
Yeah, Josh, the other side of this too, I think, is you're getting maybe just a little bit of a retail trader bid right now, right? So volume in this stock has absolutely surged over the last couple days. There was a great article from Sherwood Media and Luke Kawa over there highlighting that this has also been a popular stock on the Wall Street Bets Reddit account. And when you see moves in a stock like this, 50% in 5 days, and you and I look at our trending tickers page on Yahoo Finance frequently, you don't see Oscar Health a lot, Josh. And then all of a sudden it just comes out of nowhere, right? And I think it speaks to the conversation you and I were having earlier this week about sort of the momentum in the market that you're seeing in some of these names that just start to catch a bid, and then they're ripping higher, right? And I mean, not to compare this stock to Circle, but you're seeing it in a name like Circle, you're seeing it in the quantum computing stocks, you're seeing it in nuclear with Aqua, which we talked about. So I think it's a continuation of the theme that winners are winning right now and continuing to win, and there's clearly a retail trading bid in some of these names to just want to get in and try and chase it up a little bit. Because remember, we've said the indexes aren't really doing a lot right now, right? If you're looking for some action, you got to go somewhere outside of just outside of the major indexes.
Also, Josh Kushner, vice chairman of this company, brother of Jared Kushner.
Little Easter egg.
I'm just saying that can't hurt.
Right.
You got friends in high places. That's all I'm saying.
Always helps.
Yep. Also, Kroger, its stock rising after reporting a solid first quarter, despite uncertainty we know in that industry. The grocery store chain sharing good earnings and same-store sales grew a little over 2%. However, revenue fell short of estimates. Outlook for the year largely the same, slightly little weak according to analyst expectations. Kroger did raise its same-store sales guidance, contributing to a largely mixed outlook for the remainder of the year. Josh.
Yeah, Josh, I mean, you look at the stock over the last month, and it had not been necessarily outperforming by any means. I think it was probably in the red coming into today, so perhaps expectations had fallen just enough for a decent report to sort of give you that kind of pop, right? But I mean, always interesting when you see, to me, you always get the economic uncertainty comment now, right? That's like a given. You almost have to have it in your earnings release, I think, if you're going to put out earnings. You don't often get it, though, with the economic outlook is uncertain, but we're boosting our sales forecast. I mean, if I'm an owner of Kroger shares and I'm hearing that, I'm feeling pretty good, right? There's obviously different headwinds going on with trade policy that could weigh on a business like this, and for them to say, you know what, we're addressing that, we understand that, but we're actually now seeing same-store sales in a range of 2.5 to 3, or 2.25 to 3.25% instead of 2 to 3%. I'll take it. That's solid print.
So the stock's up nearly 20% this year. I mean, what to do with it from here? Street's actually it's just looking pretty divided. You got 12 buys, 11 holds, 2 sells. Finally, Couchbase's stock. Let's check that one out. Soaring with the announcement that Haveli will acquire the company in a $1.5 billion acquisition. The deal between the software company and the investment firm Haveli will close in the second half of 25, Josh.
Yeah, Josh, so this is not a couch company, right? They are more on the tech side of things. But what was interesting to me is I was just looking at the long-term chart of the stock here. So Couchbase went public in 2021 amid that IPO boom that we had in 2021. And then there's been a big question for a lot of these stocks is, well, what happens now several years later, right? These stocks, a lot of companies went public in 2021. A lot of them did not necessarily do great post 2021, right? So Couchbase touched $50 a share in the fall of 2021 and then pretty much never got close to it again. And so you had it caught a little bit of a bid in 2024, but its run as a public company just has not been overall that successful for shareholders, at least that were in it at the beginning. So interesting to see the 2021 IPO class stock getting bought to me.
Yeah, and I did see analysts with Wedbush cited saying good deal for both. Strategic move for both entities at these organizations closely aligned in terms of data and infrastructure build out.
Data and infrastructure build out, Josh. Buzzwords. Love it.
What else do you need? Geopolitical tensions, we know, in the Middle East are putting Wall Street on edge. Joining us now is Yahoo Finance senior reporter Ali Canal with our weekly investor playbook. Ali.
Yeah, uncertainties are building when it comes to whether or not the U.S. will enter the Israel-Iran conflict. The White House saying that President Trump will make his decision in roughly 2 weeks' time. Markets have not really done much since the escalation of this conflict outside of that spike that we've seen in oil prices. But even oil prices haven't risen to the upside to the level that's concerning here. Goldman Sachs had a new note published earlier this week. They cited poly-market data that showed markets were pricing in about a 65% chance that the U.S. military takes action against Iran by July. At the same time, though, there's also about a 50% chance that both sides can strike some sort of a deal or agreement by this year. Here's a bit more when it comes to what Wall Street strategists had to say.
It's trending in a better direction. The market's sort of comfortable with where it's heading.
I think investors' default mode on these things is just to say they don't really matter in the long term. There are two conditions where that's a different story. One is if you have direct U.S. involvement in the conflict, and the other one that we haven't seen really in any material way, but would be a sustained spike in oil prices.
I don't think there is a way to fully assess what Donald Trump is going to do because he himself has said he's not going to know what he does up until the moment he makes that decision. We've seen this time and time again with the Trump administration where you have to expect the unexpected.
Expect the unexpected. That seems to be the theme right now for Wall Street at large. Now, I mentioned oil prices, and we have secured 3 weeks straight of gains there. Brent, the international benchmark, that's hovering around $77 a barrel. crude is at roughly $75. But again, that's not significant enough to lead to greater concerns when it comes to the inflationary spiral that could create. Wall Street strategists have said that we need to see around 120 to about $130 a barrel until we see some of those concerns. So until that happens, until the U.S. definitively enters this conflict and markets need to recalibrate some of that risk, I think we will continue to see this shrug from investors. And that's really been the general nonchalant mood for a lot of overhanging risks out there, not just tensions over in the Middle East, but also tariffs, deficit concerns. And a large reason why it's because we have a lot of unanswered questions. And as we've seen throughout the entire year, things can just change so quickly.
I'm just playing oil here, Allie. We're at 75. I wonder, you never want this to come across as cold, but I just wonder if the markets ultimately conclude, listen, as long as this stays limited, as long as it stays contained, the market is willing to look through it and get back to focusing on earnings and the economy.
Yes, that really seems to be what it is. And you were just hearing from Ed Mills over at Raymond James there. He was saying that the prolonged risk of this conflict, that's not being accurately reflected in stock prices right now. So if we don't see that, then markets are saying, well, there's other things we should be focusing on. Like you were saying, Josh, earnings, what happens with the Fed, right? We just received that Fed forecast. They are still pricing in 2 rate cuts later this year, but Jerome Powell even warned that inflation that should edge higher later this summer as a result of the tariffs. So what do we see on that front? I think that is top of mind for markets right now. Of course, if we do see tensions escalate, if it is becoming more obvious that this is going to be a longer term problem, that's when I think you could see this decline on the price of stocks. But for now, they're largely looking at this as a short term issue right now.
All right. Thank you, Allie. And thank you to Schaefer. Well, wrapping up today's Market Domination. Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.